Hey there, and welcome to the Invest In podcast. I'm your host, Zac Hoyt, real estate investor, RV park developer, and your guide to turning adventures into cash flow. Every Thursday, we dive into the strategies, tools, and mindsets that help you invest smarter and live freer. If you enjoy the show, tap subscribe, rate us, and share it with a friend. Now, let's get into today's episode. This episode is brought to you by RVParkConsultant.com. They are your go-to experts for purchasing, funding, designing, launching, and growing RV resorts and campgrounds. With over 35 years of hands-on industry experience, they offer smart park layouts, creative financing solutions, and operational optimization strategies to help you save money and boost your profits. Ready to turn your land into a thriving hospitality destination? Visit RVParkConsultant.com. Link is in the description below. With ease, right? Why make it any more difficult than things need to be? Let's just make things with ease. So yeah, and I want to say big thank you to Rick and Rhonda. If you could raise your digital hand, find your little, ooh, and I rise to the top like that, digital hand. That's awesome. And we'll get them. See, good practice for you guys. So next time, there we go. Digital hand. Rick and Rhonda helping us out behind the scenes and in the RV Park Mastery group on Facebook too. If you don't know that, we'll drop something in the chat here. If someone has that and wants to help me out, that would be awesome. Welcome, Lizanne. We jamming. That's right. Jamming. All jamming. We're going to learn some great stuff. We're going to make millions of dollars. These connections that we're going to have, you never know what you're going to find in the people everywhere. So super important, right? So some other updates that we have. If you guys don't know, we are recording our podcast now every week and sharing lots of nuggets with that. I'm putting that in the chat as well, so you can check that out. Recently had Kevin on, and we were talking a whole bunch of different great stuff, right? Lots of fun technical information that's in there to help everyone out. So definitely check that out. And they're organized usually pretty well so that you can get exactly what you want. And while we're doing that as well, make sure you guys are real active in the chat. So make sure you can find the chat, smash some things in there. Get me a big yes if you can get into the chat, right? Do a yes because you want to network in there the whole time. Let people know who you are. I don't care if you spam it, right? How the heck are we going to know who you are and what you want if you're not telling us? So I'm going to try and pull the extrovert aspect out of everyone tonight. It's okay. It's a safe space. Just let everyone know what the heck you want, what you need, what your problems are, and lo and behold, they will get solved magically. Yes, welcome. Rhonda, Ed, absolutely. John, Eve, great to have you all here. So yeah, drop your contact in there, engage with people, ask questions. You can always ask questions in the chat if you don't want to ask them directly. Someone will see that and will help get your question answered. So really fun and cool. And then also stay to the end because we're going to be giving away everyone a link to the chat at the end of the meetup. So you don't have to race and copy everyone's information down, or if you don't know how to save the chat, don't worry, we're going to make it easy. Again, we want everything to be easy in life in as many ways as possible. So that's what we are here to do. So cool. I want to get some quick engagement from everyone. Anyone that has any wins, gosh, every month, right? So every month I want to hear some wins from different people the whole time of what you've accomplished in this last month. I know that we put some weekly wins in the Facebook group, but what are some wins that we have? And if you want to just raise your hand, go ahead and do that and share some wins. Anything that you want to do. What's your biggest win, right? I want to celebrate some people on this. And if there's no other wins, I mean, I can tell my team all of the fun things that we've been winning on this month. And certainly that'll be fun as well. But I want to hear from you guys. Like, where are you at? Lizanne, I know that you've got some wins. You're trying hard to get into this RV park asset class. So yeah, please unmute and share. Love to hear.
We're no longer trying. We are in the RV asset class. We are closing on a park in New York in Hudson Valley. We just got back. Yesterday was a recovery day, and just getting everything, the contract finalized, and we're figuring out our CapEx and starting to raise money, and we're on our way.
Yeah.
Yeah, super excited. It's a great park.
New York, awesome. Tell me a couple things you love about the park.
Oh, first, it's magical. It's 150 sites, 62 acres, got a great price on it. Seller, direct to seller. It's just, you're there. Like we literally cried a couple of times just at how beautiful it is. We couldn't believe it. We're just like, how is this ours gonna be, yeah, and the potential is incredible. So the sellers are elderly, they're 77 years old, they're tired, and they're just living off of the very small amount of seasonals right now. So it hasn't, they don't even want to deal with overnight people. They're just, they're tired. So the potential to bring it back to where it used to be is huge. And yeah, we're ready to go. I'm just like, can't believe it. Pinch, 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 pinch.
That's awesome. That's awesome. Congratulations. Yeah, I want to hear more about that in the Facebook group as things progress. Please share that all with everyone because that's awesome. I know it's been a fun journey that you've been on to get. I mean, it's a whirlwind getting you quickly to this point, right? So that's spectacular. And yeah, RV parks are awesome. We love them so much. Just nature and money and just great experiences. But yeah, I love that your first response is that it's magical there. That's fun. That's what you want to hear.
Yeah.
Awesome. Awesome. Love that. Thank you. Thank you, Lizanne. Any other wins? Anyone else? Raise your hand. And in the meantime, yeah, my team, our project was just featured in Woodall's Campground magazine with all the fun, exciting technology that we have going on, the robots that are shaking up drinks and manning the general store and so many fun things with that. Yeah, so we're really excited. We kind of poke our head out just a little bit for people to hear about our development, kind of like go back underground and chug away and work on stuff. But yeah, we're real excited having some success with all of that and people sharing. John, absolutely, man. What you got?
Hey, welcome. I've never met you guys before, but
Love it.
I think I saw Lizanne was like interested to go to something like this. And so I thought, I might as well jump on. No RV parks yet. Me and my partners want to buy one or two of them. So we're kind of new to the space. Just brought on another team member. We have a team of, I think, 11 now. And we brought on somebody that's just focusing on RV parks and multifamily, but mostly like 70-30 RV parks. We were in the CRM today going, all right, how are we going to organize this in the CRM? How are we going to track things? Where are we going to put, all of the information? So I'm still trying to wrap my head around how we're going to track everything, but maybe the experts in here have some guidance. We use a Go High Level white label called Built, and we just mostly do our single family stuff, wholesale and those kind of things in there. But we're starting to branch out and build this whole section of the company. So.
Yeah. Awesome. Built. Is that with Mo?
It is. Yeah.
Yeah. Okay. Yep. I know Mo and I know Built. So that's great. And that's spectacular. Yeah. If you're not in our Facebook group already, we should definitely drop that link to the Facebook group at some point, because that's a great way of connecting in between these meetups so that any of those questions that you have, you don't have to wait a whole month to ask certain questions about things and you can get things answered right away. And reminding everyone, like I am a recovered engineer, among other things. So I always thought that I had to think everything through to find all the answers in life. That's the slow frickin' way to work. It's just who and not how at this point. So just getting people that know those answers, that's what this community is about. Let's share those things with other people. And then, yeah, good to go. Yeah. Yeah, Ralph, I think you want to share something. Is that right?
Hey, everyone. Yes, we do have something to share. Actually, last week, we started the second round of investments on Hidden Beach Resort, RV Resort, and we're heading to the next phase. So a lot of things that we had to overcome with, the clearing the land, and it's been quite a bit of work, but it is coming together more and more. We had our first commercial, if you will, that we posted everywhere, attracting people and just giving a sense to what's going to look like, right? So people can come in and invest in the RV park passively. They don't have to own one. If they cannot afford one, they can come with smaller amount and hands off completely. We'll manage everything.
Awesome. Yeah. And I just dropped it in the chat, the link to the project, the second round of funding here, and the video. So if anyone wants to check that out, you'll see that above as well. Rick, what's going on, man?
Hey, just letting everybody know that Rhonda and I have decided to really work on capital raising, and we're working with the capital raising group now. Pretty excited about it. A lot of marketing that we're going to be stepping up. So we're really excited about it. Hopefully we can get back to you guys and let you know how this new system works. We've been in it for about a week now. So
great. Yeah, definitely. So anyone that's having wonderful success in any aspect of life, capital raising and funding, I'm sure everyone is very interested in general. So yeah, Rick, I'd love to hear from both of you guys, Rick and Rhonda, how things go over time. And we've got our speaker tonight is amazing. Johnathan, he's going to be sharing some funding secrets and the ways that we can get from A to B, and just how many things that we can put together with creative finance and traditional type of financing in that. So hopefully I'm not stepping on your toes with that, Johnathan, and saying that right. But yeah, excited to hear all of that he's going to share with us a little later. All right, I want to explain the structure of the meetup so that you guys understand for anyone who hasn't been here before. So basically, you guys have always heard that your network is your net worth, right? You never know who you're going to be meeting, and you don't know who the heck they know that you could be meeting as well. So all of those people could end up helping you. All of these people in the room and in the Facebook group and everything can help you. We're obviously all here for RV parks. We love them in one aspect or another. So what we're going to be doing is we really want you guys to meet each other. So you can definitely spam the chat the whole time, talk to people, do all that. But we're going to put you guys in individual breakout rooms. So we're going to have about 3 to 4 people. And I know that Rhonda's working on that furiously right now behind the scenes, getting those all ready so that we can pop into breakout rooms. We're going to do speed networking. This isn't going to be where you're going to talk about your whole history of how you got into it and what you did today and what you like to eat. Like, we need to be really focused because it's going to be short time frames. I think we only have about 7 minutes for the breakout room, and then we're going to bring you back, and then we're going to give you another breakout room so we can get into meeting different people with all of this. And then after those breakout rooms, we're going to come back. We're going to continue. You can network in the chat. We're going to have our guest speaker, and then we're going to have some Q&A, and then we're going to wrap things up. Sound good? Got it all? So the first thing I want you guys to do is to find, if you just, a lot of people like, all right, let's look at Lizanne or myself. Lizanne's great. She's got her name. She says RV Parks. She's got a little, sub 2, like the peace sign. We know that she's in sub 2, and then she has her phone number. That's wonderful. I know how to contact Lizanne with all of that. So if you can, you'll find on your picture, click on the 3 dots in the upper right, and you should be able to change your name. You'll find rename at the bottom of those 3 dots, and then just put something in there that tells us who you are and how we can get a hold of you. That'd be great, because every time you then talk in the chat, we're going to see that information and we're going to be able to move into that section. So I know that, Rhonda, it looks like you opened breakout rooms here. Okay, so everyone can click into that and we can get into those breakout rooms, and then we'll bring you back after 7 minutes. So just real quick, we're going to be just telling people your haves, your wants, and what you want to get into. And so you'll see that. So join that, get in those rooms, and we will come back.
Looks like it's just me and you're here. I can't hear you. You're muted. You're muted.
Yeah, usually I don't go into a room, but let me get you into a room. How did I put you in one? No, I have you in, looks like room 4, but I'm going to move you
Okay.
to room 3. And then, see, Kevin's in room 4 by himself. I'm going to move him also to room 3. Let's see, I let somebody else in. I have to invite somebody else. Let's see, assigned.
Did you put me in a room?
I thought I did. Hold on 1 second. Does it say? Said you were in. Oh, here we go. Let me move you. Let me move you to 2.
Oh, that's out.
There we go. There we go. I just moved you to 3.
Yeah, so Rhonda, next time, let's just wait until I say, let's go. before we do that? Because I was going to explain a little bit more of what people would be doing. And we want 3 to 4 people in a breakout room, not 5, ideally.
And then something happened with room number 4. I ended up having you and Kevin in there.
Yeah, and then there was someone else that popped in and that didn't. And we've got Phil in here now. Hey there, Phil.
People coming in here as I was splitting them up. I have to.
Hey there, Phil. Yeah. If this is the first time that you're here, we're just in the middle of some breakout rooms, Phil. You might be in a spot where you can't speak. That's totally cool. Part of what we do is we like to have, yep, that's cool. And I can see your chat, so that works too. But yeah, what we like to do in the beginning is we have a couple breakout rooms where people can meet each other, introduce each other, and actually, network a little bit before we get into everything that we're doing. But then we've got a speaker and it's all good. So yeah.
And I can put him in a room now, or I can wait. Oh, he said I can hang out and wait.
Yeah. Are you in a spot where you can turn on your microphone, or it's okay if you don't want to too? That's okay. I know sometimes people either in a bad spot or they don't want to. Yeah, Rhonda, you following this agenda that we have going on?
No.
Roughly, or no?
But I've got my countdown on. I think I have like 3 minutes left.
A minute 51, 50, 49.
Okay.
Hey, watching your kids. Want to hear your daughter crying. It would be different than just hearing my boy cry the whole time. So yeah, that would be interesting, Phil. But that's okay. That's okay. Totally get it.
Okay. You let me know when to pull it.
When to do what?
Everybody out.
Well, I assume you're just going to pull them at the end of the countdown.
Yep. I don't see your countdown anymore. That's why I was.
You should see it in the top right.
Oh, let me see. Let me close the chat.
Yeah, mine is above the chat. It looks like next to the view button.
Yeah. Let me
kind of in that
get rid of the participants section. No timer on my end.
It's curious.
Trying to click on the breakout rooms and it's not allowing me to do that now. What's happening?
You're still the host.
There it is. There it is. Okay.
Yeah, they're going to be 9 seconds, 8. They'll come back. And so you'll get them all set up, and I'll just buy a little bit of time, and then we'll hop into new.
Okay. There's your timer. Okay. I'm going to close it.
Right. All right. Welcome back. Michael, Atlanta, Phil. That's someone that entered the waiting room, so I'll let Mark in.
I think I just did.
Yep. Good stuff. Good stuff. Back. Let's see.
It's like we have 19 seconds before they close the.
It just pulls everyone back. Carly, good to see you again. Mark, good to see you. Absolutely. Hey. We're just waiting for a couple people up, and then everyone's going to start coming back from the rooms right now. All right. Everyone's pulled back from the rooms. That's awesome. That's great. Hope you guys met someone that's interesting, met someone that can help you along the way. You help someone along the way. Rhonda's going to set up a new round of rooms. And bear with us. This is one of the, this is probably the second, third time that we've done this new setup with this. Technology is always exciting, but remember, let's keep spamming the chat, because we are going to give you guys the chat at the end with everyone's wants and everyone's needs. So if you're looking to get something from someone in the group, you can see I just spammed the chat with all my information. That's my personal cell phone. That's right here. So if you need to get a hold of me, that is it, along with our website, email, what I am looking for, and our website on that. So yeah, feel free to spam that so that we can all keep in contact with everyone afterwards with ease. Again, if you came in late, if you stay to the end, we're going to be giving you a copy of this chat. Among other things, we've got a few things that we can give you today to help you along your way. But yeah, did you guys get something that you needed out of that? What's the best thing that you got from meeting someone in the last 7 minutes? And yes, I see that too. We're going to Facebook link. We need a link to that Facebook page. Who can do that fastest, right? I'm going to see. It might be me. It might not. It might be me. I'm going to share. I'm going to copy this link, and then here you go. Here's the Facebook group. If you guys are not in the Facebook group, that's the link to the Facebook group, RV Park Mastery. Looks like there's 909 people in there right now. So yeah, that's how we keep contact with everyone in between these meetups. And again, if you have any questions, host in the group. It's a happy group, a giving group, a sharing group, and we just want everyone to succeed together. That's the idea of that. And again, you'll get this chat, so you'll be able to get that group even after this whole thing is done. I know Rhonda is working. She's got that working face on, getting everything done. Yeah.
I am.
What are you guys looking for? Spam the chat with what's your main thing that you're looking for right now? Is it parks? Is it money? Is it investors? Is it some lending? Is it how to underwrite? Is it you're wondering how to get in it to begin with? There you go, Anthony, lending. Heck yeah. Carly, you're purchasing an RV park in Tennessee. Underwriting and lending. Heck yeah. Looking for investors. Oh, yeah. Hope. Mark, hope. Yeah, we have hope for you, buddy. We have hope. I will always give tons of encouragement and hope for everyone. There is so much hope, and you're in the right place. You will get there. Lizanne, just last time, didn't have any park under contract, and she now does. 150 plus, she mentioned. Yeah, that's great. Right. And for Anthony and John talking about lending, you're in the right space because we will have our lender coming on tonight. Looks like the sunset is coming in through my blinds. Love that. Love a good sunset, right? If you guys love RV parks, you probably love sunsets.
Hey, Zach, Eve also has a park under contract now, too. So here in California.
Eve, congratulations. Heck yeah. Where's all my, I'm going to find all my, I don't know. Okay. Yeah, we get some like heart. I don't know how to make any more things. Come on. Yeah, lots of excitement going on, right? That's for Eve right there. Absolutely.
Thank you. I'm ready when you are.
All right. So let's hop into one more of these networking groups, and then we will have our main speaker and have some questions. So yes, heck yeah. Sylvia, Phil, Tommy, all great. You should see something pop up on your screen right now. Hit that join button and go meet a couple people, and we'll pull you back in 7 minutes.
I just assigned you to 4. Do you see it? Hey, Jessica, how are you? That's not Jessica. Hi, Michael. How are you? Good.
Okay. How are you?
Good, thanks. Everybody's just coming back from their breakout rooms right now.
And Kevin and Ed, speaking of my other half, she just showed up, Jessica. There, she's my other half in this.
Awesome. There she is.
The person of whom I could do nothing without.
We all need one of those, or 2, but there's usually only one.
There's usually only one, and it takes a really long time to find that.
Yes, absolutely.
Awesome. Welcome back, everyone. We all got pulled back. And if you were like me in one of these rooms, we're talking to the last frickin' seconds, right? We just want to learn something from everyone that's there, and you're like, oh, all right, we'll get pulled back. I know. So I know it's like a little nerve-wracking. It's so fast, everyone just getting together. But at least we're meeting, right? You're meeting some other people. You've seen them personally. You've heard their voice. That's awesome, because the RV park community, it's a small community in general. It's a very small niche. And so for so many reasons, I love pulling everyone together. We can just help each other out, make things easier. And what about we just visit each other's parks? Isn't that kind of fun? And I know that we've talked in a previous one of these that we should all get together in person once a year at somebody's park. How nice is that? It's like going and visiting one of your friends or family and they have a spare room, except these are people with really fun parks with things to do, and they have lots of spare rooms a lot of the time. So what a fun excuse. So love that. Did you guys get some value out of that? Meeting some people, getting some stuff with that. Rhonda is dropping the Facebook group again in the chat. And again, if anyone showed up late, we're going to be giving you guys this chat afterwards when you stay to the end. So spam it and make sure that your name has your number next to it. You can change it with your little dots in the top right. And that way everyone knows how to contact you when you say that you want a park. And we don't know where to send that because we don't know who you are or how to get in touch with you. Or if you want to invest in something, you don't have my number. Well, by golly, I will give you my personal number so that you can invest with us right away, right? Like if they can't get in touch with you, how the heck are they going to do business with you? So there, I just spammed again my chat. Exactly. That's me, my information, and what we're looking to do. So cool. I love that. Thank you, Rhonda, for getting us going with all of that. So now we're going to start transitioning into our guest speaker. And this is a good one because I know a lot of you were asking about lending, and money's a huge one. If you don't have money to buy the parks, holy smokes, you're stuck at the starting point, right? And one of the things that I would recommend, and I've always told this to people, it's one of those secrets. It doesn't matter what you're looking to buy in real estate. Literally doesn't matter what asset class, but start at the end and work backwards. So start at the end and work backwards, meaning what's your exit strategy? Are you looking to get this under contract and wholesale it? Okay, go find a buyer for that thing first. Start at the end. Are you looking to fix it and flip it at the end? Okay, well, you're going to have to figure out how to own it for a short period of time. So find a good lender and figure out what's needed for all of that. Work from the back and work forward. If you want to own this forever, then you're not only going to need a bridge type of lender, you're going to need that long-term, that buy and hold type of lending package with that. And sometimes they're together, but all I'm saying is start at the end and work backwards so that you're not just hoping and praying as you find a lead, you call a lead, you're excited, and then you're like, oh my gosh, what do I do next? Now, I also want to talk to my fellow engineers that are in here too, or anyone that's an accountant, very detail thinker of things. Don't just keep thinking and figuring out how to do everything and start at the end because Zac said start at the end. You're like, oh, I got to figure everything out before I start. No, for you just have to pick up the phone and call people and put offers in. Right? Your biggest issue is just starting at the beginning. And so there's a little bit of starting at the end, starting at the beginning, and you meet in that happy place in the middle, and then you're good to go. Yeah, and Nathan's dropping in here, right? He's got a bridge lender that transitions the loan into an SBA loan. Yes, absolutely. SBA is a great product for exiting some parks. And when I say some, there's just some issues with certain parks being too big. There's different loan products, but I'm going to let Johnathan, the lender now. Johnathan, that's a much better name than just Johnathan. Hey, yep, our speaker is listening too. I love that, right? So you can tell so much more when people add some color to their names on this. So, all right, real good stuff. Love all of this. So now we're going to transition to Johnathan. I've got a little bio for you. All right, Johnathan Taylor, and he's going to be discussing creative financing for RV parks and campgrounds. Johnathan has personally originated, so as a lender, a broker for a lender, he's personally originated over $100 million in loan volume since he started in the lending business almost 6 years ago. That's a lot of money in just 6 years. His expertise focuses on investment lending, ranging from DSCR to value add, construction lending, short-term rental loans, mixed use, RV, mobile home park lending, and all of that. That's okay. We love our mobile home park. He has his own rental portfolio, both in and out of state, including renovations, ADUs, conversions, extension, and long-term rentals. His experience paired with his unique understanding of the loan programs has helped him advise his clients into the best loan products for their needs. Oh my gosh, and we get this expertise right now. Johnathan, please come on down and share this with us.
Zac, that was a great intro. Thanks, man. I appreciate that. All right, guys. First of all, thanks for your time today. I know we're all busy, so it's great that you're showing up to be able to share your expertise and learn a little bit. So I hope I make your time worth it. So I'm going to get my screen share going on here. And I just want to lay this out that this is not an all-inclusive list, nor is it an all-exclusive list. There are exceptions and there are alterations to what we're going to go through today. So I'm just going to lay out sort of the 5 general categories of lending, types of parks, problems I've seen with deals I've underwritten, and then open it up for questions, right? Because I know as we're all here for the RV park lending, each parks are unique, right? There isn't just a contiguous standard type of park. And that's kind of why lending is always going to be a little bit tailored to the exact product. But we'll get into that right now when I share my screen here. And also, I work in lending and I do not work in design. So this is going to be a very colorfully simple aspect here. Here we are.
You're doing a wonderful job putting things together. Don't undercut yourself. It's great. And for everyone, if you guys have questions, if you want to just raise your hand while we're going along, that's great. John said that he would love those questions. And if you don't want to speak those questions, feel free to type them in the chat, and either Rick or myself will end up asking those. And then we'll have time at the end too. Cool.
Yeah, exactly. So this is more of a conversation than a talk. So let me know if you guys have any questions as we go. So As we're here for RV park lending. So what are you guys going to expect from this talk? This is just, I'm going to approach how a lender would look at this asset class, right? What they see, what they're not concerned about, and kind of the main aspects of the park that are most prominent to lending, right? I'm going to go over briefly. I know a lot of you know this, but just sort of the types of parks, just so we can kind of know when you're looking at one type of park, when you're communicating to a lender, hey, it's this type of park, and that usually helps narrow down the financing options. One thing I'm also want to highlight is things to pay attention to. This is something that might be overlooked by someone who's relatively new or inexperienced, or someone who's dealing in parks that have different unique amenities. These are things that I've noticed that lenders have an issue with, and how to remedy a few of them, right? And then I'm going to go over 5 types of loans that are the general category. These can be mixed and matched, right? They're not exclusive, but I just want to kind of give you that breakdown so you understand when you're looking at a project, what are going to be the types of loans that you know you're going to be targeting and the ones you're not, right? We already went over that on this one, but I'll have that at the end of it. So the first question I have for everybody here is, what is an RV lender's primary job? This is ultimately what is a lender asking you. Does anybody know that answer? Don't be shy. Jump in here.
Lend money.
Good question. Not number one though. Anyone else have any answers on that? What are they looking for, right? What is their main job? Ultimately,
the loan.
Good. Again, we're still in the top 5, but we're not in the top 1, right? Because their ultimate job is analyzing risk. That's what they do. They're going to associate a loan to you, determining the risk they have within their pipeline. That's ultimately what it is, because high risk means they're not sure if they want to leverage that much, because their factors of risk, or whatever lender you're going to, would say, I don't know, it's in a disaster zone, it's not zoned correctly, it's not fully operational. That's higher risk to me versus you're already on a franchise tag of KOA, you're next to a seasonality, you're next to a huge attraction. That's less risk, so therefore we want to lend to them, right? And so then your loan terms will be determined by the type of risk that you're in, right? So analyzing risk is their ultimate number 1 paper. So as an operator, you also should be looking at that. How risky is this investment in a lender's eyes? Let's go over the types of risk. These are all going to be play into kind of how we're going to be looking at the financing, right? So it's property location. Ultimately, we're all in real estate here. We know that location is number 1. If it's in a rural location, your risk might be higher. What's your experience, or what's your partnership experience as a whole? Does anybody own RV parks or mobile home parks? Because there's a lot of crossover in those two in this asset class, right? Guarantors liquidity. This is something that a lot of people struggle with. And when you're looking at parks in the $4, $5, $6, $10 million, the lender wants to know that there's somebody behind it who's guaranteeing it, that they have other assets to collateralize, right? They want to know that we're not going to lend to somebody who doesn't have any money, or who doesn't have any assets to help us understand that our risk tolerance as a lender is going to be a little bit more, it's higher if we have somebody on that loan as the guarantor, mind you, not as an operator, who doesn't have a lot of liquidity, right? Loan to value, that's another risk, right? Because RV parks, unlike residential 1 to 4, they're not really comparable sales to compare RV parks. They're wide and varied. So if you're asking for a 90% loan to value on a $10 million park, that's a higher risk. If you're asking for a 50% loan to value on a 10 million park, lower risk, right? Another thing about ability to repay. Is the property making money? If it's not, higher risk. Maybe a long-term loan isn't right for you, right? That's basically saying how much money is the property making, and can you afford your mortgage payments, right? This covers into your debt coverage ratio. Very similar to multifamily, we look at this as well in the RV park space, right? Your park's amenities, i.e. your diversification, right? If you only have pads and you're just a pass-through park, then you only have one source of income, versus on some of the breakout groups we're talking about, I also sell fishing gear. I have a restaurant. I also have awesome robots that deliver drinks to my guys. That is a diversification of the park, right? So that means it's less risk, because you're not completely contingent on one source of income, and also your size of park, right? If you have 10 pads, if that's going to be rough. If you have 160 pads, then that is the less riskier, because you have more diversification, right? Types of operation is similar in the amenities. Also, your historical financials, right? Because that's called your trailing 12 or your T12s. You need to see how the property was operated previously, right? That's sometimes in risk. It's not a huge factor, but I just wanted to include in there. And then this is something that I'm seeing a lot more in the last 3 to 4 years, is natural disasters, right? Florida, my lenders are stopping to look at Florida just because of the cyclones, right? California, the fires aren't too much on their RV parks, but also flooding and hurricanes. Those are starting to become more bigger, and making sure that the insurance covers that. All types of risk, environmental hazards are as well. So again, not an all-inclusive list, but just kind of like the top bullet points that we need to cover. So for this, also just understand rate on your mortgage is relative to the risk the lender analyzes. So let's go over briefly the types of parks. I'm just wanting, so we can kind of know which types of parks might be good for which types of funding, right? So you have your destination seasonal extended stay, right? Not all inclusive, but just want to go over that. And these are ones that are located near, say, you're near a lake, you're near theme park, you're near a beach. Those are all kind of like destination seasonal, right? So you have higher average daily rates, right? Your ADRs. You include more amenities, right? You have a more diversification of your options, and people want to stay there longer, right? They go to your park and they don't just use your park as a stop off to go to somewhere else, right? The downside is it's subject to seasonality. I know in the northern hemisphere is kind of on the East Coast. When the winter comes in, attendance goes down, but in the summer times, that's when they're the busiest, right? On the flip side, you have your pass-through parks, your year-round, or also called your transients. That's lower average daily rates, right? They're stopping at your park while going to somewhere else. You don't have as many amenities as your destination, shorter stays. They're more stable though, because they're usually on a major thoroughfare. There are people that are going there and it's less seasonality. So there's benefits and positives, right? But these can be crossed over, right? You can have a pass-through park that actually is near a destination, or you can have a destination that is year round, right? In California, we have good weather out here, so a lot of our parks are year round. So now let's get into the lending part. This is the part that I specialize in. This is the part that I can talk about for a while. I won't, but I will. So I'm going to give you this one slide. It's just going to show the 5 types, and then I'm going to get into it, right? So this slide will stay up for a second, but just know I'll show it again at the end. So the things to pay attention to. The park's profile. This is one thing, is that when you're buying a park, when you're looking at it, I as a lender will look at it as well. Touching in on the risk factors we spoke about earlier, but just know, you want to know the overall. We call this the prospectus, right? The park's profile. If you're looking to buy a park, make sure you have a quick overview of the amenities, the type of clientele that comes through, how it's being managed. Is it owner managed? Is it third-party management? Is it a combination of the two? And also, are you branded? Are you a KOA? Are you another type of that? Or are you trying to create your own brand? One thing that's really important is the zoning. That is something that a lot of people look over, because some types of zoning do not allow RV parks on it. It varies by state, so there's not a real overview that we can do, but just understand that you need to make sure that you're legal and compliant with the zoning. Because if you're what we call in lending legal non-compliant, meaning you might have been legal at some point, but now you're not compliant with the current zoning, that does cause issues in the lending space, because that means that our collateral, i.e. the park, if it's completely gets destroyed for whatever reason, then it can't be rebuilt, then the lender's like, well, I don't want to lend on it, because then I have a higher risk, which is from the earlier, right? One thing I'm seeing also is a combination of long-term stay, like mobile home parks or cabins, mixed with RV parks or pass-through. So we need to see how many of those mobile home specifics are owned, because that actually counts as a negative in our space when we're looking at specifically mobile homes. That's kind of where we're talking about how mobile home parks and RV parks have a little bit of crossover. And that's just something to pay attention to, right? I won't get into much right now because that's a different conversation. Also, the trailing 12, I mentioned that earlier. You want to know how the financials are currently operated, right? If you're sitting here and say the average amenity or the average electricity and utilities for an RV park in your area, say, is 35% of income, and you look at a trailing 12 and it's 12%, they're doing something wrong or they're hiding something. And so you can have a really good understanding on a trailing 12-month profit and loss statement that gives you as a buyer a lot of education on the property. You can say, okay, well, I see that their expenses instead of the average 35 is now 65%. That's a value add for me. I can help reduce that or change some of the amenities to be more economical. That means you have a leg up from somebody else who didn't dive into that details, right? Another thing is the reasons the sellers are selling. I know a lot of folks are retiring and going through it, but you want to know that, because there could be hiding something if they're saying, oh, you know what, I just don't really like it. But you look on the paper and they're making hand over fist cash. Well, that seems a little weird. Why would somebody want to sell a really good business unless there's a valid reason? The second is a lot of counties and states have environmental violations listed either on building sites or some centralized database. And the reason I think this is important is when you do any sort of commercial purchase, if we're going, say, a more full document conventional loan aspect, they're going to order an environmental evaluation. It's called a phase 1. That means somebody who's educated in environmental will go out and just take a look, making sure there's no oil, like I'm just going to make stuff up here, but like just vats of oil sitting in the ground or jet fuel in the corner. That means that if it has an environmental violation, your asset is the land, right? Because you guys in RV parks don't own a lot of structures. But if your actual land is toxic, then that's going to look bad. And that's going to be really hard to lend on because that has to be remedied. And environmental remedies are usually costly. So that's why you ask these questions when you're going through, hey, have you had a phase 1 or a phase 2 done recently? How did that come out? And this just shows, one, you're a sharp investor, right? You're coming into this knowing that I want to look at comb through the grass from the top, bottom down. And I know that environmental, that can be a reason, because if you buy something on, say, has an environmental violation, then that violation transfers to you and you have to remedy that, right? This is not a common thing, but it's just something that we're seeing more and more in this style of lending. And another thing is the RV park comparables in the area. It's going to be a wide net because it's not like they're next door, but you want to see that, hey, there's a 150 park 50 miles away that sold for 5 million. Why is my 60 park being asking 10 million, even if the amenities are the same, right? That just gives you a gauge in the market. This isn't a huge one, but it's something, crime statistics of the park, right? And this is more for the half and half parks that have more extended stays and then for short-term stays. And that's just something where you just want to be aware of that. You're like, how many police calls have I had, if any? What have they been around? Have they been very petty crimes or more serious? This just gives you an idea of what you're walking into. And then lastly, and this is just more of a subcategory, if you are buying a franchise, know how the franchise is organized. What's the franchise fee? What do you have to do? What's the percentage annually? Because if you don't know that, that really could cut into your profitability. So here's the types of loans. I'm going to show this at the end once we go through it. But just so you know, we're going to go over 5 general types of lending. We're going to start from the one that has the most underwrite, the one that has the least underwrite, right? And then we're going to kind of go through the pros and the cons of each, and also different types of projects that these are perfect for and ones they are not perfect for. So that's what I was saying earlier. You want to make sure you know, I'm not going to waste time on this lending option because I know this park won't fit it, right? So the first one is a conventional loan. A lot of people might not think that RV parks are allowed to have conventional loans, but they are. There are specific types of properties, and we'll get into that. Right? These are ideal for stabilized income producing parks in desirable areas. For those of the folks in this group that are coming from multifamily, that's basically, we're going to call this an A-class property, right? They're ones that are operated well. Maybe the lender or maybe the current owner just wants to reallocate into a different asset, which is totally fine. And they're just wanting to sell at top dollar, and you're going to take over and then just generally improve over time, but you're already cash flowing, right? So these are the pros. The types of loans on this are usually one of the lowest rates on the market, right? And this is if you're purchasing and you don't have any seller financing, right? They have fixed rate terms. They're usually 5, 7, and 10-year fixed rate terms. They're amortized, usually 20 to 25 years. There's variations to all of what I'm saying here. These are just generally how they're structured. The debt coverage ratio, basically your rents divided by operations, usually needs to be 125 to 135, depending on the location. The expense factor, again, that's just basically what it takes for you to operate. That's utilities, expenditures, maintenance, etc., not including your debt coverage, your debt mortgage. The expense factor usually varies by location, but RV lenders in this space, they usually have already information for your specific region on other RV parks they've closed that are on their books. So they usually come to the table when they're underwriting with an expense factor from their experience, right? So that varies. And when an expense factor is calculated into lending, they usually take the higher of the two. If the operational expense factor is 35%, but the lender says we own 5 other parks in the area or we lend on them and their expense factor is 40, they'll use 40 because they were going to be safer. This is a longer underwriting process, so they're always going to be more conservative. And these values are income-based values. So that's how the lender will value it, is based on the income the property generates. And again, the other pro is it's the lowest rates on the market. But like everything, pendulum swings the other way. Right, so what are the cons? Hold on. The cons, pardon that. So I will go over this here in a second. Well, I'll read this out because I'll have this at the end. So the cons are, these are the harder loans to qualify, right? So they are not for the fast close. They're not for the person who doesn't have any liquidity. They're not for the person who's a brand new experience, right? So they take a long time to get done. The average length of time varies greatly, but you're talking probably 120 plus days just because you need appraisals. You need to make sure you go through that process. Secondly, these usually do not allow subordinate financing. That means that if a seller wants to carry, say, 15, 20, 25%, these types of loans traditionally, again, there's always variances, do not allow that type of financing. And usually you have to come to the table with 20 to 30, maybe 35% down. So it's going to be a lot of cash down for you to be able to get that loan. Apologize about the option for that one. The second is SBA loans. I saw this spoken about in the group, and that's great you guys are bringing it up because these loans are ideal for owner operators in a desirable or desirable adjacent area. These are fantastic if you can qualify for them because they have the lowest down payment on the market. If you're buying a $10 million property, you only need to put 10% down, right? And these are up to 30-year amortizations. So there's a much longer term you can have this loan. Times these loans can be assumable sometimes. And that's another huge pro on this one is you can go in there and if you're going to sell the property, say after 5 or 6 years, you can advertise assumable mortgage at a below market rate. You'll get a ton of buyers with that one. It has to be lender specific, but sometimes it can be assumable, right? The other pro about this is newer owners and newer operators can qualify for these, right? Because you're basically buying a business, and this is a small business association loan. So you can basically have everything laid out, and you're saying, hey, I'm going to live on the property and I'm going to operate it myself. Perfect. That means that the experience is not as heavily weighted as a conventional loan that I spoke about before, right? So that is something that is huge. And the other huge pro is it's the lowest rates in the market, right? So they vary by market, so I won't quote anything on this one, but I'm just saying these are the ones that are the best. Again, okay, that was my technicality on that one. The cons on the SBA loan. So these usually are much more stricter underwrites, right? So these take a long time, sometimes up to 6 months to be able to qualify because they comb through everything when they're looking at the SBA loans. That honestly is one of the biggest cons on this one. And they are property specific. So if there is a property that you want to do a massive value add to, an SBA loan is not the option for you. So you need to make sure that you're basically purchasing a property that is similar to the conventional loan. There are little things you can do to improve. Like I know somebody was speaking about they want to buy acreage next door and improve that way, but the 26 acres that they were looking to purchase is already operational. Then that would be another SBA loan that probably would fit, assuming that the location is where the lender wants to work, right? So that is something that, again, there's always variance to these types of loans, but SBA is usually the ones that a lot of my clients like to go for. But you have to make sure you have the time. So if this is a property that needs to be offloaded quickly, SBA loan is not the option for you. If this is a property that shows really weak current financials and maybe you guys don't have the liquidity to be able to operate it, SBA is not for you. This is for people who want to buy, want to operate, want to live on or live near, and basically are on a longer term strategy of growth. That's where an SBA loan would work. So the next is commercial bridge. I know Zach was mentioning this one earlier. These are ideal for value add properties. A commercial bridge can be paired with an SBA. A commercial bridge can be paired with a conventional, right? So this is just one aspect. And this is, if your strategy is just to buy, flip, and sell, commercial bridge is where you're at. So that's another thing. The pros are, these are faster closes. They're not as fast as where we'll get to at the end, but usually these are just still looking at experienced folks. They want to make sure that the asset itself fits all the risk factors that I spoke about earlier in the talk. And these are interest-only terms, right? So you're not paying principal for the entire term. The term will vary depending on the lender and depending on your scope of work, right? If you're buying 160 pads and you want to, you know that, well, all the plugins are super outdated, but you're not going to replace all 160 at once. I'm going to do 25 now, 25 later, and you're going to do a phasing, as we call it. You're going to renovate the property in phases. That's where this would work out. So your project scope and your project timeline, the lender will match a loan option that fits you. So I've seen these up to 3 to 4 years. Sometimes they're as little as 12 months. But that's where being in communication with your lender, being in communication with the guy who's bringing the money is really important, because they want to make sure that if you go up to your balloon payment, which means that you're going to owe the same amount of money at the end of the term as you did at the beginning, that your exit strategy needs to be buttoned up, meaning that you know how you're going to get out of this. So say your renovation goes haywire, say your electrical is worse than you need to, You're backed up into a balloon payment. So you're going to own that money regardless if you're finished or not. And that's where the risks are. So I think my technicalities, I'm not sure if the cons will show up here, but that's why I'm getting into them now. So the cons are, yes, you have an end date for this loan, and it's a shorter term than what we talk about on the other ones. And you're going to owe that money whether you're finished or not. So you need to make sure that your exit strategy, you have plan A, plan B, plan C, because on these types of loans, they usually have a minimum loan amount. They're not going to lend on $100,000 or $500,000 properties. They're usually going to be in the millions, right? So when you have a $2 to $3 million bridge loan coming up, you want to make sure that you have a really good exit strategy on that. Lastly, your rates are going to be higher, right? So these are going to be interest only. Rates vary by lender, but they're usually going to be 200 to 500 basis points. And a basis point is basically 100 basis points is a percentage. So when lenders talk, we're talking basis points. So they're usually going to be in the high single digits, low double digits, interest only mortgage. And we're talking about $1, $2, $3 million loans. That's a pretty hefty mortgage payment every month. So they're also going to ask you what's your ability to repay, because you're buying an undervalued and non-operational asset. So your income from the property, that's not how these are looked at in terms of the underwrite. They're usually looked at it similarly to when you're buying and renovating a home in the single multifamily space. What are you buying it for? What's your renovation? And what's it going to be worth once you're done? Those three numbers hold a lot more value here. In the commercial bridge, lenders might have other specifics that they might ask you. What's your experience? Okay. If your plan doesn't happen, what are you going to do to pay for it? That's where assets of the operators are more heavily looked at, because they want to make sure the lender that their money is protected on something like this. And that's where we do something called cross collateralization. And that's where if a guarantor comes to the table and say, hey, I actually have 5 other properties worth $1 million each, the lender might say, great, what we're going to do is we're going to put a second position on those other properties to mitigate our risk, because this deal might be too risky for us. So that's where assets and operators need to come to the table. Or I mixed that one up. So the assets of the operator basically are important on these types of loans, because these are folks who are not new, and this is a product that is geared toward the experienced investor. Those are the other options. Okay, yeah, see, technical slideshow didn't work on that one. Another one is seller financing. This is the most popular, to be direct with you, because a lot of RV parks do fall outside of a lot of traditional funding. So seller financing is ideal for properties that just get unfavorable loan terms. Sometimes RV parks are just outside the realm, or the property itself is either too rural, or it's just, the list goes on, but lenders just say, you know what, this isn't for us. So seller financing comes to play. Again, seller financing can be mixed with other things, right? So seller financing can be mixed with a commercial bridge, right? Seller financing on some occasions can be mixed with a regional lender, right? Who still is under the commercial financing, but they allow what we call seller second position, right? That means that the seller in the order of liens is in second position. And that's where I have seen these work quite well. So these are highly negotiable, right? You can talk to somebody who's run the park for 40 years. They want to get out of it. You're a motivated buyer. You can negotiate until the cows come home, right? There's not a fixed structure to these types of loans. 2, they're historically lower rates, right? A seller, if they know much about the property and know about the lending market, they're not going to give you a seller second at 10%. Right? They'll usually give you something that works because they want to sell. They're motivated to sell, so they want to give you terms that get you to buy. Very flexible loan terms, right? It could be a 5-year amortized over 30. It could be a 30-year amortization. Whatever it is, there's a lot of options here. And sometimes, I've only seen this twice in my career, it's a low or no down payment possible. One scenario that this works is you take a commercial lender and you put them in first position at 55%. That's very low risk for a commercial lender. They go, wait, I'm in first position. That means that if you default, I've bought your property at 55 cents on the dollar, right? That's how a lender would think of that. And then a seller second comes in at a second position, right? That means that if everything, worst case scenario, the property forecloses on, then the first position is the commercial lender and the second position is the seller. I mean, they'll get paid second after the first position gets all their debts met. So if you have a 55% first and a 45% second together, that's a no money down deal. I've only seen that twice, but I just want to say, as I spoke about earlier, we're always talking about kind of gray areas. This is not a black and white situation in lending. So that's where negotiation is a real important key. So if you have a negotiator on your team, and a seller financing is on the table, this is a good option for you. Again, I think my cons option's not working. A con of this one is it's not that you can't mix it with all loans, right? This isn't a one size fits all. And the unicorn deals that I spoke about earlier, they're usually they're not all there. But this can be combined with a commercial loan with a lower down payment. That's also where I've seen it work. But again, the cons are you're also marrying yourself to the seller, meaning that they're the lender. So that means that if your relationship goes sour or something doesn't work or they don't fully understand seller financing, you're tied to them for the length of that loan that you've negotiated. And I have done refinances where the relationship went bad and they just needed to get the other person off their books because it just wasn't working. That is probably one of the biggest cons. The other con is sometimes you're not dealing with a bank, right? You're dealing with an individual who may not understand financing as well as myself or other lenders do. So it can be a real struggle to be able to make sure you have that work. Sometimes it can work great, but sometimes that's just something I've seen. Those are the main cons on that one, but just keep seller financing in your toolbox because that's something that's becoming much more popular now. Now, lastly, the fifth one is basically the one that doesn't work for all the other ones, right? Private money financing. Private money, hard money, they're kind of synonymous, but they basically just mean it's a short-term bridge note at high interest. It's similar to a commercial bridge, but it's less underwrite. And these are ideal for properties that don't qualify for the first four. Or you need a fast closing, right? Say a seller is hitting some legal troubles and he just needs cash. And he's like, you know what, this is my last asset. I'm just getting it off my plate and I need to move this quickly. Private money would be your ticket because it is a speed play. I wouldn't say it's necessarily of a longevity play, or it's used when you need renovations, right? So the pros are you get hard deals done with private money. These are people that can come in there and they can say, yes, we understand this asset class. We understand the reasons why you have speed. So therefore the fast close. So these are usually 2 to 3 weeks. And this is sometimes, this is sometimes when other financing options are going through and they fail and you're backed up against basically a contract expiration date. That's where a private money call is where it comes through. Another pro is it's a limited underwrite, right? They're not going to ask for environmentals. They're not going to ask for multiple appraisals. They're not going to be asking for, we need to analyze your profit loss statements to its entirety. They're usually having a much more efficient process because they know what asset you're collateralized. Right? And these are interest-only payments, right? So you're not paying any principal throughout this process. And there's usually no or low prepayment penalties. That's another thing of these. There's usually what's called just a minimum interest collected. That means that if interest is $10,000 a month, they say our penalty is if you refinance in the first 6 months, we just get 6 months of interest, right? That's it. There's nothing else associated with that, right? Experience is not as looked at as diligently as SBA or commercial underwrites, right? So they're looking at people who are saying, we're going to basically come to the table and we're going to get this thing closed. So we're not going to heavily underwrite your experience, right? Sometimes, and this is usually in better markets, you don't need to get even an appraisal. They do what's called a desktop review, very similar to what they do in multifamily or single family. Again, I think my cons are not working. So the cons are here though, you're going to have to come to the table with a lot more down payment. That's where the mitigating risk factor is, right? You wouldn't be able to do this private money financing at 10% down on a 5 million. So you're probably going to be looking at 30 to 50%. Right? That's one of the largest cons that deter a lot of people. But if you're in a syndicate and you're doing a raise and you're saying, hey, there's still value here and the deal still pencils, that's kind of where it works out. Also, the cons are it's much more expensive loan. It is the most expensive loan, right? So you're going to be in the double digits. You're probably going to be paying a couple points and it's going to be the most expensive of all the 4 options in terms of cost to close, right? The other one is it's similar to what we're talking about. Commercial bridge is you need to have a pretty buttoned up exit strategy because you are going to be getting into something where your loan is going to be due in a certain amount of time and you need to make sure you have an out. So again, ideal for fast closes or very quick turns. You're going to go in there, you're going to renovate and you want to offload quickly. Those are the options for this one. So I know we're covering a lot here, but I haven't seen any questions from anybody. Is there anything that we've covered here that anybody has any questions on?
Yeah, right. I think Lizanne mentioned it. Yeah, everyone's just intently listening to you. Good stuff.
Okay, good. So this is just that slide I showed earlier. Just kind of a quick little, you guys can screenshot this if you'd like, just showing the types of loans, right? Left side is conventional, best options, longer underwrite, and on the right side is private options, longer underwrite. I do have some of the cons here because I know my technicality wasn't working. So that's just kind of where we're looking at, right? And again, you can mix and match of some of them, not all of them. So these are just so you guys can walk away from this talk knowing that your toolbox is not just seller financing and bank financing, right? And lastly, this is a trick that might save you all some time that I didn't have in slides, but I had just reminded me when I was talking to everybody. If you're doing your own financing, right, meaning you're trying to find your own, don't start at a big bank. They do not invest in RV parks, right? We're talking Chases, B of A's, East West Bank, any of those. They're not going to even take your calls. Look regionally, right? So look at regional credit unions. Those are really the ones that'll want to take a look at these, because credit unions, part of their operations are they have to invest in local businesses. RV parks, as much as they are a real estate, they're more of a business than a real estate because of how you can operate it. There's so many different character ways you can operate an RV park than you can with multifamily. If you're doing a 10 unit, you can either rent it long-term or short-term. There's not a lot of options. But with an RV park, you have a lot of ways you can create income. There's a lot of ways you can do it. And you have a massive marketing budget, right? So think about credit unions specifically that specialize in RV parks. Normally I wouldn't say into that because that kind of cuts me out of the deal, but just you guys are here because you want to learn something. And that is something where when you're looking for financing, start there, right? So that's generally what this whole talk was about. I didn't want to go into too much details on the specifics of this, but I think that with these of what we're talking about, that gives you guys a pretty solid coverage on what we're looking at for financing options. So I'm going to still leave the slide up there, but we're talking again about a lot. This kind of is concluding it. Do you guys have any questions at all about anything specific? Or I know some of you guys are under contract to some deals. If you want to share your financing, I'm happy to give you my opinion on kind of what you're looking at, or if I can help you structure it better, then I think we can all learn from that. So I'm going to kind of lean it over to you guys. If there's any questions, you guys go ahead and type it in the chat or just raise your hand and speak up.
Yeah, thank you, Johnathan. That's wonderful. So anyone, please raise your hand. You want to share your deal for one, to let him see what's the best path for you to go down. Or if you have any other questions, of course, feel free to raise your hand as well. Screenshot his information, and maybe we can dump that into the chat as well. That would be awesome. And if no one has any questions for things, I mean, I've got questions for days. We'll fill this
Zach,
up,
jump in there.
What do you have? I want to leave it for everyone else that's here. But yeah, so it basically seems, Johnathan, until we get anyone else, at the right half of your screen for those options are if you're doing a value add, and the left half is for anything that's stabilized and that's, you know, good and easy, and you want to go through the long process of qualifying.
Yeah, again, these are not an all-inclusive or an all-exclusive list. So there is some mix and match options. Like I said, you can mix commercial bridge with commercial financing, or you can just do commercial bridge and then sell. Like all of these do have options, but yeah, you pretty much nailed it. Lending is a spectrum.
Yep. Okay. And then just to mention those regional credit unions, would they be open to a value add situation, or are they more like a bank where they want things to be stabilized?
It varies by institution. Traditionally, though, when you go to a credit union, they are more specific, because they're what we like to call balance sheet lenders. That means that if they give you the money, they're not selling that loan on the secondary market. They're basically giving you the funds that they have in their coffers, and then they're collecting the interest for the mortgage payments, right? So when they're lending their actual money out, they tend to be more strict on that underwrite. But sometimes they might not be, right? Because there's so many federal credit unions, a lot of them are regional. They still tend to be more on the commercial side of underwrite than on the private money side of underwrite.
Okay, awesome. And let's talk about some of these issues that people might have. So there's plenty of people that are in here that could be starting out and they're thinking, man, I don't have a lick of experience with RV parks. So how do I get around that? How many ways, I'm going to ask you, can people get around that issue?
It's perfect. Great question, Zach. And that's probably the most prominent that I think you guys can walk away from this talk is as has been said in this one, is your net worth is your net worth. So you alone should not be able to take down a park of these calibers, right? When you're talking about 100, 200, whatever pads you want to do. It's very impossible unless you're independently wealthy, lots of experience to be able to take them down. So that's where partnerships come into play. I know a lot of folks in here are looking at syndications for types of purchases, and that's where you have your general partnership. Usually these are the folks where together the team makes a complete whole. So you have somebody who has financing but no experience. You have somebody who has time and experience but no money. and you have somebody who also is really good at financials and business operations, right? Those are ideal teams that you can generate, and you guys can be the general partners. On the bigger deals, you can do a syndication, right? Commercial financing can be done with syndications. So that's where you come to these meetups like you are today. You say exactly what the start was, which is like, I have X, I need Y, right? I have $1 million, but I have no experience in RVs, right? So that's going to be the guarantor who's coming to the table, and they can partner up with somebody who has the experience but not the money, and they can partner up with somebody else who has the business acumen, or they have understanding of the RV business, and they can come to the table so that you have operations as a whole. So ultimately, the answer is you can partnership would be the answers to be able to get around that. A lot of credit unions allow that. A lot of lending allows that because this asset class is so conducive to partnerships.
Awesome. And so I did notice that nowhere through there did you ever talk about a credit score. So for some people that might have a bad credit score, how does that factor into things?
So usually the guarantor is going to be the person who has the higher credit score. But if you're an operator and you're in the 600s, that's fine because you're not guaranteeing the loan. So when we spoke about partnerships, if you're going to be the finance person or you're going to be the one bringing the table, your credit score is going to be very important. But it's not going to be a cumulative credit score of 3 partners, 4 partners, 5 partners, however many you have. So that's where this asset class isn't too heavily leaning on the credit scores. I can't speak on all. Like I said, some local credit unions might be specific to having all credit scores above a certain level. I haven't seen that before, but I haven't done every single loan, so I can't speak with certainty. But from my experience, it's the limited partners, or sorry, the general partner. The general partnership guarantor, their credit score will have a lot of weight because they want to make sure that they don't have any delinquencies, they're not late on mortgage payments, and they have a really good credit history. So that's kind of why I didn't focus on that, because I don't want to deter people with low credit scores to be able to invest in this, because if you're not the guarantor, then it's not important.
Yeah. So it's awesome. So basically, for any of these things that you guys don't have,
good news.
Yeah, individually, you can get from somebody else that you can be a partner with to do those things. Does it mean that if I have no money, I have destroyed credit, and I don't know what the heck I'm doing, do I have to be below a certain percentage of ownership on the operating agreement? How would that end up working?
It's more about what is that person's goal, right? Because for us to be able to look at ownership, we would need at least 20% of the vesting entity to be owned by you for you to be able to claim ownership on future deals, right? So if you say, hey, I'm an RV investor, like, fantastic, let's see your schedule of real estate, and you own 1% of 10 RV parks, as a lender, we can't use that because that's not enough experience for us to really be able to say, what, I mean, you have enough ownership of these properties, you don't, because it's only 1%. Versus if you're 20% or greater of the vesting company, like the LC or syndication, then you can classify that as an owner. So if you have no money, no credit, no FICO, maybe you just jump in as a limited partner and then you learn from the syndicators that are doing it. Or you jump in as a silent partner with a lower stake and then you're able to learn. So your payment of that is learning from the other people in there. And that's working into the highly negotiable aspect of companies and partnerships, because you can structure it any way you want. But to answer your question directly, for us to be able to use experience, they need to be at least a 20% owner of the owning company.
Yeah. And that's what I've always come across is if you want to skirt away from all of that, be under 20% and the lenders aren't going to look at you. They don't care at that point. But the downside of that, to what Johnathan was saying, is that you can't use that experience to say that you now have experience owning an RV park for your next one. So a little bit of a double-edged sword with that. So it's just balancing those things out. So, but of course, your ownership could change down the road as well. Okay. Yeah. So that's a way of getting around it. But John, you've got a question. Let's go.
Yeah. So just to clarify, no experience. Let's say you have a good credit score. You work the deal. You negotiate it well. You get under contract. Then you bring in general partners. If you personally aren't bringing 20% of your LLC into that deal, that's what you're talking about, where you can't claim I own an RV park, because that's the kind of the line in the sand.
If I understand it correctly, you're saying when you say personally bringing 20% of the LLC, what do you mean?
Well, when you were talking about the 20% rule, right?
That's basically meaning that if you want to claim that you're an owner of this RV park, as a lender down the line on deal number 2, we need to see that you're at least 20% owner of
or lender criteria. Gotcha.
For a lender criteria, right? So if you go down the line, right, saying on deal 1, you own 20 or 25%. Then on deal 2, you can say, hey, I'm an experienced operator because I've owned 20%. Versus if on deal 1, you only own 10%, then on deal 2, you wouldn't be able to claim experience because that's the threshold for experience qualification.
Gotcha. All right. So as you work your way up and you get more capital, and then you can bring more to the table if you want to get into that 20%, and you just start leapfrogging from there and become
exactly.
somebody like a Johnathan or Zac and somebody like that, where you can walk around with something on your shirt. I own RV parks. #lenders.
I might take that up on the next convention. But yes. So
Great, thank you.
I hope you're welcome.
Awesome. So great. I know if you guys want to spam the chat real quick, last chance, get your information in there because Rick's going to grab it all and give you guys access to that. So we're going to do last minute, 1 minute of that. And then Rick, you can just grab that chat as we're moving. And while we're doing that, I know that Rick is also going to give us something from the Generational Camping Report from OHI, Advanced Outdoor Hospitality. So it's lots of detail about what's happening in our community and everything, and how things are changing in the RV park community. So that's a good resource as well, a good PDF he's going to drop in here. And then I know we're running low, but maybe a quick example, Johnathan, of what could work. So for instance, my team and I are closing on an RV park in Marina where we got seller financing with 30% down. And the 70% is a seller carry that he agreed to be junior to any financing that's out there. So what would be a good avenue of financing for that? So it's essentially 30% down, 70% carry. And we want to do a value add with this and do some expansion on it. And then refinance to own it 3 years down the road.
All right, I'm going to break that down. So 70%, you're saying the seller is willing to subordinate in second position on 70%?
Millionth position, doesn't matter, junior to everything else. Yes.
My first question is why?
It's what he agreed to. He owns it outright. And so $1 million is enough for him down to do something. And that's what it is. Stop asking why. Let's just solve the money problem.
Well, my first question would be, have you done an environmental, and does zoning comply?
Zoning complies. We haven't done an environmental.
So I would just say, because that to me is, if I'm only going off of those numbers, right? So first of all, congrats on negotiating a fantastic deal. That's incredible. Secondly, though, that does seem quite desperate in the seller's eyes, because if he's willing to take a 70% second position, that means you can get another lender coming in first position at 30% and mean that he just bought that property for 30 cents on the dollar. And you basically have 100% financing, right? So you can close at 30 and then get a first position the next day on a hard money loan or a short-term commercial loan. And then you can renovate with that $1 million. And then in those 3 years, you can get a 36-month term. Then you can refinance as long as you've had at least 90 days of stabilization if you're non-seasonal, to be able to start looking at commercial options around year 2.5 to give that 6-month timeline to be able to refinance. But my first question would be, read deeper between the lines of the sellers looking to do 70% first position. I haven't heard something that high before, unless I'm missing something.
He's just tired a little bit, and I gave him a few different options, and I leaned him towards the one where he wanted to get a little bit more for it, for a 70% carry.
Okay.
So I was going to say, you asked why, and it makes me laugh because Johnathan, he's the books person, right? He's the mortgage broker, so he looks at it from this mentality. But when you have personalities, kind of like Zac or my personality, right? And we're coming in and we're building that relationship with the seller, and they trust us, and we can finagle the numbers to make them more comfortable. It's less booky, so it's more difficult to understand from your viewpoint. But for us, it's kind of like what we did, right? Right. Zac?
Again, how you negotiated that, I would tip my glass to you. That's an incredible negotiation, right? So I'm not saying no, but I know from my underwriting that would be the first question any lender would ask, is why.
Yeah.
So
he's old,
but
he's tired,
if everything checks
he wants
out,
to get out of it.
Everything checks out. You got good books. You have a good solid plan. I would have lenders tripping over themselves to lend you 30% loan to value on an IO loan.
Great. Yeah.
So
we can chat about that.
So I would say, Yeah, I would say take notes, and maybe I could learn something from you about negotiations. So that was great.
Yeah. So I started in all of this 2 decades ago with no money and destroyed credit. So I had to do everything creative. And you make your money when you buy, everybody. But you need to know what you're doing on the exit so you don't trip up along the way with all of that. And just to let everyone know, we are now 2 minutes over. So I'm going to wrap this up. I'm going to say thank you, Johnathan, so much. Oh my gosh, lots of value. We dropped the link to the Facebook group. So I'm twisting Jonathan's arm to make sure that he joins the Facebook group. So if you guys have any further questions or stuff, we'll continue this forever, right? You can ask him questions and work with Johnathan forever and everything. Then Rick, share some stuff. Yeah, I know that there's a link that Rick dropped in the group as well for the chat and that generational OHI. But go ahead, Rick.
Yeah, I just want to say thanks for everybody for showing up. And I hopefully what we're doing is bringing value to all of you. And if it is, let us know. Or if you need us to tweak or something you think we could do better to support us as a group, let us know. But please invite other people and friends that think they can get value out of this. The more people and the bigger community we get, the stronger we are as a group. For example, I actually met Zac through this group about a year ago and built a relationship online, and then we bumped into each other at a couple of conferences, and now we're working together, putting this whole thing together. So you can meet people in this forum that are going to benefit you and your business and your goals. So please help support us and support everybody else.
And we're all friendly, happy, giving people. If Rick ever needed anything, I would be right there for him, right? And any of you guys too, because you are here. And I'm a happy, loving, giving soul, and I'll twist someone else's arm. If I can't give you what I need, what you need, I'll get it from someone else to get your issue solved. And so that's what we're about, everyone. So awesome. Great stuff. Thank you, Rick. Thank you, Rhonda, for helping out with this. Thank you, Ralph, for some of the marketing. My gosh. Thank you, my team. Thank you, Johnathan. Thank you all for showing up and being here and asking questions. And we're going to do it all again next month, third Thursday of every month. Excited to have you guys again. Have a wonderful weekend and take care, everyone. Go buy some RV parks. Make some money.
Can I add one more thing really quickly? I put a link in the chat for the meetup group. So if you join the meetup group, then you will get notifications on all of our upcoming events.
Get in there. Get everywhere. Hang around with us.
Thank you, Johnathan.
Cool. Thank you, everyone.
All right. Take care.
Out.
Bye.
Bye-bye.
That's a wrap for today's episode of the Invest In podcast. I hope you picked up insights to fuel your investing journey. And if you enjoyed the show, please leave a rating and review. It helps more adventurers like you find us. For behind-the-scenes content and updates on our RV resort projects, follow @GoInvestIn on Instagram, LinkedIn, X, Facebook, TikTok, and YouTube. Want to dive even deeper? Visit MaverickAsherInvestments.com for resources and tune into next Thursday for another episode. Until then, keep investing, keep exploring, and I'll see you on the road.